Okay, so let's unpack this. Welcome to the deep dive.
Good to be here.
Today we're really plunging into, well, a period of pretty intense change in Luxembourg, regulatory, economic. It's moving fast.
It really is. The speed and the sheer volume, it's precisely why this kind of focused look is so important right now.
Agreed. So our mission for this deep dive, we're taking a whole stack of recent official announcements, stuff from the CSSF, the AED, the LBR.
Yep, plus legal texts, market reports, mostly from late May, early June 2025.
Exactly.
Yeah.
And we want to pull out the absolute essentials for you, the key knowledge, the actionable points you need if you're navigating this whole landscape.
Vital stuff if you're working in or, connected with Luxembourg. And just the usual reminder up front.
Oh, yes. Absolutely.
While we're diving deep into these sources, this is all for general information. It reflects what's in these specific documents around now.
Doesn't count as financial, legal, or investment advice.
Nope. Always check the info yourself. Talk to qualified pros for your own situation.
Definitely. Think of this as your briefing, straight from the source material.
Yeah.
Okay, I'm ready. There's some really transformative stuff happening.
There really is. And maybe before we hit the specific rules, it's worth setting the scene. The economic context these changes are happening in.
Good point. What's the ground look like?
Well, Luxembourg's definitely in a period of, let's say, significant regulatory acceleration. You need to be proactive.
And the economy supporting this.
Yeah.
What's the latest data telling us? Is it like a clear picture?
Actually, it's quite nuanced. That's according to the recent Statec data from May 2025.
Okay.
So the broader Eurozone saw a bit of a GDP uptick early in the year. But for Luxembourg specifically, the services sector, which is huge here.
The main engine, yeah.
Exactly. It seems to be losing a little steam. Some momentum's gone. The data points to, well, less favorable signs for business health and demand in areas like legal, accounting.
Management consultancy.
Yep, and other related professional activities.
Huh. That's interesting. Those sectors often feel like the bedrock. So does this softening, does it connect to how firms should maybe tackle all this regulation?
Oh, absolutely. It really does. If you sort of connect the dots, this mixed economic signal, especially that cooling in key services, it just highlights how critical operational efficiency and strategic adaptability are right now.
So being good at compliance isn't just a cost anymore.
Exactly. For firms in those sectors maybe facing a slightly tougher outlook, success could really hinge on how well they help clients navigate all this complexity. Compliance services, risk management know-how, operational resilience. They become value propositions, potential growth drivers even in a tighter market.
That's a really smart way to look at it.
Yeah.
Any other economic pointers from the data?
Construction is showing maybe some tentative signs of improving confidence, but, it's still at a low level.
Baby steps.
Kind of. There's a mention of a slight rise in new housing deals, which is good. But yeah, lots of construction firms are still held back by financial constraints.
Right.
And on the labor side, the minimum monthly wage is EUR 2,703.74 as of May 1st, 2025. The next likely automatic wage indexation, probably looking at Q3 2026 based on current forecasts.
Okay, so we've got this complex background, slowing momentum in some core areas, cautious optimism elsewhere, cost pressures like wages. And this is happening when earlier forecasts, like from the European Commission back in autumn 2024, were suggesting stronger GDP growth for Luxembourg this year, for 2025.
Precisely. That contrast, it really underlines the pressure on businesses. You need to perform efficiently, adapt strategically. It adds weight to the idea that you don't just absorb these regulatory changes, you implement them smartly. Streamline things, reinforce resilience.
Speaking of resilience,
Yeah.
let's shift to those massive digital transformation drivers.
Yep.
DORA and MiCA. They're not coming soon anymore, are they?
No, they are fully operational. DORA, the Digital Operational Resilience Act that's been directly applicable since January 2025. Its main goal, a harmonized framework for managing ICT risk in finance.
And the CSSF, Luxembourg's financial regulator, is the one in charge.
That's right. The CSSF is the competent authority, and they've been pretty busy issuing practical guidance on how DORA actually works on the ground.
What have they put out recently?
Well, a key one is Circular CSSF 25893 from May 28th. This spells out the details for reporting major ICT incidents, how DORA entities do it.
Okay, the how-to guide for incident reporting.
Exactly. But here's where it gets really interesting. It extends these specific DORA reporting rules to all payment service providers, PSPs, even those not fully under DORA for everything else.
Wow. So even if you're a smaller PSP, maybe not totally in DORA scope, you still have to report IT incidents the DORA way.
That's the takeaway. It simplifies reporting overall for the CSSF, presumably, but yeah, it significantly raises the bar for those PSPs not fully in scope otherwise.
Creates one standard for incidents, I guess.
Right. Also from May 28th, there's Circular CSSF 25892. This one mandates using specific joint guidelines from the European supervisory authorities, the ESAs.
EVA, ESMO, EIOPA.
Yeah, them. For estimating costs and losses from major ICT incidents. So clear rules on how you quantify the financial hit.
Okay.
Back in April, we got more clarity, too. Circular CSSF 25883 updated an older circular on outsourcing, basically for DORA entities, that old circular. Now it only applies to business process outsourcing. Any ICT outsourcing falls squarely under DORA's rules, which are often stricter.
Got it. DORA trumps the old rules for ICT outsourcing.
And critically, Circular CSSF 25880 from April 9th. This one applies to all PSPs, DORA or not. It covers really key areas like user relationship management, ICT assessment procedures, and it adopts new EBA guidelines for managing ICT and security risks, specifically for payment services.
Okay, that's a lot of interconnected pieces just for DORA's operational side.
Yeah.
What's the bottom line for firms? What do they actually do?
The absolute key is documentation updates, major ones. You have to revise your internal ICT risk frameworks, align them with DORA's detailed demands. Your incident response plans, they need updating to reflect that new reporting circular, 25893. And if you use any ICT outsourcing, those contracts need a really careful review. Possibly renegotiation to make sure they hit all of DORA's specific contractual points.
And there was that register deadline, too.
Yes, the DORA Register of Information submission, the deadline got extended to May 31st, so that was a very recent compliance hurdle. Oh, and making sure you have solid documented telework policies, another DORA requirement.
Okay, let's pivot within digital. MiCA, markets in crypto assets. How's that implementation going?
MiCA is also being rolled out fast by the CSSF. They're implementing detailed standards coming down from ESMA and the EBA. We've seen a whole series of circulars.
Like what?
CSSF 25891 came out May 21st, effective May 25th. That applies ESMA guidelines on suitability requirements and periodic statements. Really important if you're doing crypto portfolio management or giving advice.
So bringing that familiar suitability idea from traditional finance into crypto makes sense.
Exactly. It's all about investor protection, reinforcing that. Other recent ones, CSSF 25885 from April 30th applies EBA guidelines on templates for supervising issuers of ART asset reference tokens and EMT's e-money tokens.
Okay.
Then CSSF 25886, also April 30th, applies ESMA guidelines that help figure out if a specific crypto asset should actually be treated as a financial instrument under existing laws. That's a really fundamental classification.
Yeah, that determines which rulebook applies.
Right. And CSSF 25888, again, April 30th, implements ESMA guidelines on the nitty-gritty, procedures, policies, client rights for crypto asset transfer services.
So the plumbing for moving crypto around.
Pretty much. And even back in February, the circular CSSF 25875 applied joint eBay-ESMA guidelines on suitability for the people running the show management, key shareholders for ART issuers, and CSOA SP's crypto asset service providers, making sure they're fit and proper.
Wow, that is a rapid rollout of very technical standards. What does this mean for firms on the ground, documentation-wise?
Well, if you're in the crypto space or thinking about it, your client agreements, your terms of business, they need updating. You've got to reflect suitability, those crypto transfer rules.
Well,
You need solid suitability assessment protocols if you're advising or managing portfolios. Your periodic statements need to comply, format and content-wise. If you're issuing tokens, the crypto asset white papers, they're like the prospectus, have really specific MiCA content rules.
false.
Internal governance needs to cover suitability checks for key people. And you need clear policies just for crypto transfers. The sources also mentioned the CSSF wants detailed business plans, operational diagrams with applications, and for EMT issuers especially, those pre-notification timelines are tight. 40 working days before you intend to offer, 20 working days before publishing the white paper.
At pace?
Yeah, the CSSF's rapid pace here. It's a clear signal they're committed to building a really robust MiCA framework. Investor protection is definitely front and center.
Okay, moving from digital, let's talk broader compliance and governance. AML, CFT, anti-money laundering, and counter-terrorist financing. That seems to be a huge focus in these updates, too.
Oh, absolutely. A really key document dropped on May 26th, the updated 2025 National Risk Assessment, the NRA, for money laundering and terrorist financing.
And what's the big finding there?
A significant one, and something the authorities are clearly emphasizing, is that legal constructions, think trusts, fiduciaries, complex corporate setups, they're assessed as having the highest inherent and residual money laundering risk in Luxembourg. Commercial companies are next.
Highest risk. That's a strong statement.
It is. Now, the NRA does say, effective mitigation can lower the risk. It uses audit professionals as an example, saying they have low residual risk because of their strong controls and professional duties.
But that headline finding about legal constructions feels like a very direct signal to anyone involved with them.
It certainly does. And fitting right in with that, the AED, the Administration de l'Enregistrement des Domaines et de la TBA, has taken a pretty major step.
What's that?
They've enhanced AML-CFT reporting and specifically brought all unregulated alternative investment funds, AIFs, explicitly into scope.
All unregulated AIFs.
Yeah.
Not just the regulated ones.
All of them. And the sources say the AED is being very clear about stronger enforcement in 2025. They're talking increased penalties, fines for noncompliance.
So the spotlight is really on unregulated AIFs now for AML. And there were deadlines. Immediate ones.
Critical ones, yeah. May 31st just passed. That was the deadline for RIF's reserved alternative investment funds to get their RC reports and AML-CFT questionnaires into the AED.
Okay, RAF's deadline was May 31st.
And June 30th, 2025, coming up very soon, is the deadline for all other unregulated AIFs. That's equally critical.
And what do they need to show?
The AED has been clear. These AIFs must be able to demonstrate they have an adequate AML-CFT policy, a documented risk appetite statement, a proper risk analysis for their specific business, mitigation measures in place, and the defined risk-based approach.
That sounds like a substantial compliance lift for unregulated funds if they weren't already fully on top of it. What are the practical takeaways here for, say, service providers or other obliged entities?
The main message is vigilance and updates. If you're an obliged entity, especially if you deal with those higher risk structures the NRA flagged, or if you service unregulated AIFs, you absolutely need to review and update your internal AML policies, your procedures, your risk assessments.
Make sure they align with the NRA and AED's focus.
Exactly. And for any unregulated AIF or its service providers, getting those RC reports and questionnaires ready and submitted by June 30th is an urgent priority. The AED's signals about increased enforcement. They're not messing around.
Got it. Okay, shifting slightly within governance. The LBR, the Luxembourg Business Registers, they've been tightening things up on ID numbers.
Yes, exactly. The LBR is enforcing the rules more strictly around the Luxembourg National Identification Number, the LNIN. For individuals registered with companies, directors, managers, beneficial owners.
And they put some real deadlines on this,
Yeah.
with consequences.
They certainly have. The sources highlight a few key dates. May 31st, 2025, that was the last day to update these LNINs for free.
Okay, free window closed.
Right. From June 1st, so starting now, there's a fee for each update. But here's the big one, the potential bottleneck. From October 1st, 2025, the LBR is indicating they might actually block other statutory filings.
Like what?
Most notably, your annual financial statements. If the required LNINs for people linked to your entity are missing or wrong in the register, they could block your account's filing.
Whoa, blocking the account's filing for a missing ID number. That suddenly makes getting those LNINs right a very high priority.
It absolutely does. It means you need to be checking the accuracy of LNINs for everyone relevant now, and you need to update your internal onboarding for new directors or managers. Make sure you get the LNIN, verify it, file it promptly. You definitely don't want your accounts blocked in October over something like this.
No kidding. Okay, let's turn to the investment fund sector then. Huge part of Luxembourg's financial center. How are global and EU standards hitting funds right now?
Well, a big global update came from IOSCO, the International Organization of Securities Commissions. On May 26th, they put out revised recommendations for liquidity risk management, LRM, for funds.
Okay, managing liquidity risk.
Exactly. These updates align with the Financial Stability Board, the FSB, and importantly, they incorporate lessons learned from market stress events, like back in March 2020.
So updating the playbook based on recent real-world wobbles seems sensible?
It is. It's about boosting preparedness. And related to this, ESMA, the European Securities and Markets Authority, is also working on rules for liquidity management tools, LMTs.
Those tools funds use in stressed markets like gates or swing pricing.
Precisely. This is part of the ongoing AIFMD and UCITES reviews. The aim is to get more harmonization across the EU on how and when funds can use these tools.
So what's the practical impact for Luxembourg funds or funds managed from here?
It means your fund's LRM policies and procedures need a thorough review. You've got to check them against these new IOSCO standards and also anticipate the upcoming EU rules on LMTs from ESMA.
Looking at things like stress testing.
Yeah, critically reviewing your stress testing methods, the range of LMTs you actually have available, and how the board or management company decides on using them.
Okay. What about benchmarks? Funds use them all the time. Any changes there?
Yes. A key piece of EU law is the amended EU Benchmarks Regulation 225914. It was published May 7th, and it starts applying from January 1st, 2026.
What's the main change?
It sort of refines the scope, puts more focus and stricter rules on benchmarks considered critical, significant, or those making ESG claims.
How do they define significant now? Is it clear?
There's a clear quantitative threshold.
Right.
Generally, if a benchmark is referenced by instruments, contracts, or funds in the EU with a total average value of 50 billion euros or more
50 billion.
over 6 months, it's likely significant. But national authorities can still designate one as significant based on qualitative factors, even if it's below that number. And administrators of these significant benchmarks, they'll need to get authorized or registered fairly quickly once the law kicks in. ESMA also gets a bigger supervisory role, especially for benchmarks from outside the EU that are used here. And importantly, mandatory ESG disclosures are coming for any benchmark making ESG claims.
That definitely impacts funds choosing and using benchmarks.
Absolutely. Funds need to review their prospectuses, their offering documents, update benchmark disclosures, particularly if they use anything claiming ESG features. They also need to figure out if any benchmarks they use might trip that new significant threshold, either the 50 billion or the qualitative bit.
Could influence which benchmarks they pick going forward.
Could do. And it means reviewing internal policies on benchmark usage.
Was there any sort of positive local news for the fund industry in these updates?
Yes, actually. One welcome change mentioned is the extension of the subscription tax exemption. It now covers actively managed ETFs as long as they qualify as UCITS.
Ah, good news for the active ETF market here.
Exactly. That was effective from January 2025, so it's already in place. Clearly aimed at making Luxembourg even more attractive for that growing segment.
Anything else operational?
Yeah, for funds dealing with PRIPES packaged retail and insurance-based investment products, there's a new CSSF system for submitting KIDs, the key information documents. It's a delegation management system, goes live June 26, 2025. So internal processes need adapting for that.
Okay.
Oh, and the sources briefly mention recent ESMA updates, ISRB updates related to UCITS and the prospectus regulation from May. Just means you need to keep monitoring for the detailed rules flowing from those.
Right. Always something new coming down the pipe.
Okay.
Let's move away from funds specifically. What about changes hitting corporate law, maybe cross-border M&A, financing, things that often connect to banking too?
Sure. A big one here is the full transposition of the EU Mobility Directive. That's Directive 21 Amendment 21/121. Luxembourg passed laws in February and March, and the employment parts took effect April 1st, 2025.
The Mobility Directive. What does that impact?
It significantly changes the game for cross-border restructurings involving Luxembourg companies. So think cross-border mergers, but also conversions and divisions.
How does it change things? More hurdles?
It introduces new enhanced rights for employees, information rights, consultation, participation. Crucially, these rights, which used to focus mainly on cross-border mergers, now explicitly cover cross-border conversions and divisions too.
So same level of employee involvement across the board for these big moves?
Pretty much. And there's a specific new requirement. For any restructuring plan published on or after April 1st this year, management has to provide explanatory reports just for the employees. Also, the safeguard period for maintaining employee participation rights after the deal. That's extended from 3 years to 4.
Okay, so definitely more employee protection and information baked into cross-border deals now. It needs careful planning.
Absolutely. Needs factoring into the timeline and process. On financing law, the sources touched on clarifications to Luxembourg's interest limitation rules, Article 168 EBIT LITL.
Right, the 30% EBITDA cap, roughly.
Yep. Yeah, generally limits net borrowing cost deduction to 30% of EBITDA or 3 million euros. The recent changes brought in this concept of a single entity group. Under specific conditions, especially for certain standalone setups like securitization vehicles, this might allow a fuller deduction of interest costs.
Ah, so clarification that could help some common financing structures here. That's potentially quite useful.
Yeah.
You mentioned another law coming into force soon that affects lots of businesses.
Yes, the law of March 8th, 2023. It's about accessibility requirements for products and services, and it enters into force very soon, June 28th, 2025.
Accessibility, what does that cover?
It's broad, applies to many economic operators, and explicitly includes financial service providers. It basically mandates that products and services offered to consumers, digital interfaces, websites, apps, but also physical services, must be accessible to people with disabilities.
That sounds like quite a significant compliance task across many sectors, finance included. Reviewing websites, apps, maybe even branches?
It could be yes. Reviewing digital platforms, physical access, service delivery methods, ensuring they meet the required standards. And just looping back quickly to banking specifically.
Yeah.
As we said, DORA and MiCA apply directly to banks, depending on what they do. Circular CSSF to 25880, the one we talked about under DORA, is really relevant for banks acting as PSPs, sets those specific, higher ICT risk standards for payment services.
Okay.
And looking slightly further ahead, remember the MiFID II MiFIRA review. Transposition deadline is September 29th, 2025. That's bringing a whole wave of detailed Level 2 measures from ESMA that will definitely impact banks' conduct, investor protection rules, reporting. Lots to come there.
Always something on the horizon. Okay, let's tackle tax. I know this can feel, well, complex, but there have been some key changes from recent bills, mostly hitting the 2025 tax year. Can you simplify the big points from Bills 8414 and 8388 for us non-specialists?
Will do my best. You're right. The tax changes are kind of a strategic balancing act for Luxembourg, trying to stay competitive, comply with international stuff like Pillar 2, but also adjust internal rules. Let's break down the key shifts simply.
Okay.
First, corporate income tax rates, CI2. They're nudging down slightly. Standard rate goes from 17% to 16%. For companies with lower profits, it goes from 15% to 14%.
So bottom line, slightly less tax on profits. What does that mean combined, say, in Lux City?
Yeah, with the municipal business tax added on, the combined effective rate in Luxembourg City will be around 23.87%. So yes, companies pay a bit less tax on profits from 2025.
Okay, a small rate cut. What about that minimum wealth tax?
That's been simplified. The calculation for the minimum net wealth tax, NWT, is now based just on the company's total balance sheet value.
Easier calculation.
Should be. It results in a minimum annual tax somewhere between EUR 535 and EUR 4,815, depending on how big the balance sheet is. Just a more straightforward way to figure out that minimum tax on net assets.
Okay, simpler minimum tax. Anything giving more certainty on specific deals.
Yes, they've clarified the conditions for when redeeming or canceling specific share classes counts as a non-taxable partial liquidation for the shareholder getting bought out.
More clarity on share buybacks and cancellations then.
Exactly. Gives more certainty on when tax is due or not due in those situations. Another interesting point is an optional waiver for the participation exemption.
Hang on. Why would a company choose not to take a tax exemption? They usually like exemptions on dividends or capital gains from shares they hold.
Right. It seems counterintuitive. But this option, starting 2025, gives flexibility. It could be useful for managing tax outcomes under those new global minimum tax rules, Pillar 2. Sometimes waiving the exemption might simplify things or lead to a better overall result under those complex global rules.
Okay. It's about navigating the interaction with Pillar 2, potentially.
Got it.
Filing changes. Anything practical there?
Yes. Mandatory e-filing is coming in for withholding tax returns on directors' fees and wages. Starting for the 2025 tax year, those specific declarations must be filed electronically.
No more paper for those. Fair enough. And those interest deduction rules you mentioned earlier, Article 168 ibis.
Right. The basic rule limits net borrowing cost deduction to 30% of tax EBITDA, or UR 3 million, whichever is higher. The recent clarifications brought in that single entity group idea.
Which helps certain structures.
Potentially, yes. For specific standalone setups that meet the criteria, like some securitization vehicles, it might allow them to deduct more of their interest costs, even if they exceed the general limits. It helps accommodate certain financing structures.
So the limit is there, but this clarification provides a potential route for filler deduction for specific cases like securitization.
That's the gist of it. And just to quickly recap a couple of other points we touched on, that subscription tax exemption was expanded to active ETFs effective Jan 2025. Makes Luxembourg more attractive there.
Good for active ETFs.
But for SPFs, Sociétés de Patrimoine Familial, those private wealth vehicles, the minimum annual subscription tax has gone up significantly, from 100 euros to 1,000 euros.
Oh, big jump.
Yeah, effective 2025. And there are new penalties for not complying too, so higher minimum tax and stricter enforcement for SPFs.
Okay, that is definitely quite a sweep of changes across digital, compliance, corporate, funds, tax. Phew. Given the sheer volume and the speed, maybe a clear action checklist is what people need right now.
Absolutely. Being proactive with these dates is just essential to stay compliant and avoid trouble. So, based on the sources, let's run through some critical near-term deadlines and changes.
Hit me with the checklist.
Okay, May 31st, 2025, just gone, was super busy. Last day for free, LNIN updates at the LBR, deadline for RAIs to submit their AED-RC report and AML questionnaire, and the extended deadline for the DORA Register of Information to the CSSF.
Right, so if you missed May 31st for LNIN updates, that cost now.
Correct. From June 1st, a fee applies for LBR LNIN filings. Now, looking ahead, June 26, 2025, that's when the new CSSF Kid Delegation Management System for PRIPES goes live.
Okay, new system for kids.
Then just 2 days later, June 28, 2025, that law on accessibility requirements for products and services kicks in.
That accessibility law affects a lot of businesses, including financial services.
It really does. Then another key AML deadline, June 30th, 2025. That's the deadline for other unregulated AIFs to get their RC report and AML questionnaire into the AED.
Okay, June 30th, the other unregulated AIFs.
And don't forget that LBR point about the LNINs from October 1st, 2025. Remember, they might start blocking other filings like accounts if those numbers aren't sorted.
Yeah, that potential filing block is a serious consequence. Definitely don't want that. Any key dates further out to just keep on the radar?
A couple, yeah. September 29th, 2025 is the deadline for transposing the MiFID II amendments, so more changes coming for investment firms, banks then. And January 1st, 2026 is when that amended EU benchmarks regulation starts to apply.
Right, so the pace isn't really letting up, is it?
It doesn't look like it. These dates just underscore that continuous change is the norm right now.
Okay, so after this pretty intense deep dive into all these rapid shifts in Luxembourg regulatory, economic, drawing from all these recent sources, what's the one thing, maybe an insight, a deadline, a piece of info that really stands out most to you, our listener? We're thinking about what resonated most.
Yeah, maybe building on that, here's a final thought to consider. You see how interconnected all this is, right? Digital resilience, crypto, AML, governance, funds, tax, even accessibility. And it's all happening so fast. So the question isn't just, how do we react to rule X or deadline Y? It's more, how do you or how does your organization build a genuinely integrated, resilient, adaptable framework? One that can handle this constant evolution strategically, not just piece by piece.
That's a great question. Moving beyond just reacting. Building true adaptability is something to definitely mull over. Thank you. This has been incredibly helpful navigating this complex terrain.
My pleasure. Always good to talk through it.
That wraps up this deep dive. We really hope you found it valuable. Stay informed, stay adaptable, and we'll catch you on the next one.